Welcome to Iron Financial. We're the place you come to forge a stronger portfolio because we stress test the market's biggest names. Today, Alphabet is on the anvil. Their Q4 earnings report just hit the street, and on the surface, the numbers look like an absolute monster. But the market is acting spooked, so the big question we have to answer tonight is this. Is Alphabet an impenetrable financial fortress, or is it just a crumbling facade with a shiny new coat of paint?
And this, right here, is the paradox that's confusing everyone. On one side of the ledger, you've got a spectacular, undeniable beat. Revenue, profit, top line, bottom line, they just crushed Wall Street's expectations. This should be a victory lap, plain and simple. But then you look at the other side. You look at the stock's reaction in after-hours trading. It is a knife fight in a phone booth. The stock is whipping up and down, which tells you the headline numbers are not the whole story. There is a brutal war happening between the bulls and the bears right now, and we're going to figure out who's got the upper hand.
The market clearly can't make up its mind, and you know what? That's where we come in. Here at Iron Financial, we don't just read the headlines. We take a sledgehammer to the balance sheet to check the structural integrity. Our mission today is to figure out if this volatility is a massive red flag telling you to run for the hills, or if it's one of those rare generational buying opportunities. And of course, to keep me honest, we have our market skeptic.
Yeah, my job here is pretty simple. I ask the questions that every single one of you watching at home is probably thinking. Is this real, sustainable strength we're seeing, or is this just a bunch of hype propped up by some fancy accounting? I'm here to find the weak points. Let's dig in.
All right, here's our game plan for today. First, we're going to lay out the bull case. We're calling it the growth engine roars. Then we'll flip it and hit the bear case, the price of dominance. After that, we're going to inspect the very foundation of this company, the ad business, and check for cracks. And finally, we deliver the Iron Financial verdict. Let's get to work.
Okay, so we are starting with the bull case, and I have to be honest, these top-line numbers are just overwhelming. If you're a bull, this is the picture you paint. It's a portrait of a company firing on every single cylinder, operating at the absolute peak of its powers. This isn't a complicated story. It's a simple one, of pure scale and relentless, unstoppable growth.
I mean, just look at this number. $113 billion in a single quarter. That's more than the entire annual GDP of a lot of countries. But it's not just the size, it's the acceleration that should blow you away. For a company that's already a trillion-dollar behemoth to be growing its revenue at an 18% clip, that is almost unheard of. This is hard proof that their products aren't just sticky, they're basically becoming critical infrastructure for the entire global economy. This isn't just a beat. It's a statement of pure, unadulterated economic dominance. Now, let's move from the top line down to the bottom line, where the story gets even better. Earnings per share, or EPS, absolutely smashed what the analysts were expecting. This is a beautiful thing called operating leverage in action. What it means is, as the revenue machine gets bigger and bigger, each additional dollar they make costs them less and less to generate. Their profit engine becomes hyper-efficient. So let me be clear, they are not just making more money, they are getting fundamentally better at making money. For an investor, that's the absolute dream.
And what's the result of all that incredible efficiency? Well, it's this, $34.5 billion in pure net income. And that's up 30% from the same time last year. This is the hard, cold cash that builds a fortress of a balance sheet. This is the money they use to fund moonshot R&D projects, to gobble up competitors, and to reward shareholders. For a company this big, this mature, growing profits by 30% is nothing short of astounding. This is the absolute core of the bull thesis. All right, the numbers are huge, I get it. No one can deny that. But we've seen this playbook before, haven't we? Is this just the old legacy ad business, printing money like it always does, while masking some serious weakness in the newer, more important ventures? Is the foundation really as strong as the giant skyscraper they're trying to build on top of it?
You know, that's the perfect question. It's the exact question a skeptic should be asking. And it leads us directly to the real star of this entire earnings report. For years, the whole bear case against Alphabet has rested on one simple idea, that it's a one-trick search ad pony. Well, this report officially kills that thesis dead. The narrative that is going to define this company for the next decade isn't ads anymore. It's the cloud. Would you look at this chart? This is a hypergrowth startup story that just happens to be embedded inside one of the world's biggest companies. Google Cloud revenue absolutely exploded by 48% year over year. Let me say that again because it's important. This growth is accelerating. At a time when competitors are actually slowing down, Google Cloud is hitting escape velocity.
This isn't a side project anymore. This is the company's second act, a brand new growth engine that is quickly becoming a foundational pillar of the entire business.
And here it is. This is the knockout punch. For years, the big knock on Google Cloud was that it was just a cash-burning vanity project to keep up with Amazon and Microsoft. Well, not anymore. Look at this. The operating margin nearly doubled in a single year to over 30%. They have officially cracked the code on profitability. So now, cloud is no longer just a revenue story. It's a legitimate profit gusher. It's putting them in the same league as the biggest players in the space, not just on technology, but on financial performance. The fortress is getting taller and the walls are absolutely getting thicker.
Okay, that is a very, very rosy picture. A fortress of growth and profit. But you know what? Fortresses aren't free. They cost a fortune to build. And sometimes the sheer cost of construction is enough to crack the very foundation you're building on. I see the growth, you've made that point clear, but my job is to ask, at what price? Let's look at the numbers that are making the market so nervous. It's time to uncover the bear case.
You know, this quote I pulled from the trading forums. It perfectly captures the market's fear right now. This is what real investors are talking about. They're looking right past those shiny revenue numbers, and they are seeing a giant flashing red warning light. They see this level of spending as completely unsustainable, a really dangerous trend that's hiding just beneath the surface. And the question they're asking is simple. Are they right to be scared?
And here it is. This is the number that has the bears sharpening their claws. Capital expenditures, we call it CapEx. It's the money they spend on physical stuff like servers and data centers. It nearly doubled, a 95% increase in 1 year. Let that sink in. They are spending a staggering amount of cash. We're not talking about building new offices here. This is an unprecedented investment in silicon and steel. And the question for all of us is simple. Is this a brilliant strategic investment for the future, or is this a panicked, undisciplined spending spree to catch up in the AI arms race? This, my friends, is the crack in the armor. Can the foundation really support this much weight this fast?
And here is the immediate, painful consequence of all that spending. A 42% drop in quarterly free cash flow. This is the number that has Wall Street completely spooked. Remember all that beautiful net income we were just celebrating? Well, that nearly $28 billion in CapEx basically vaporized a huge chunk of it before it could ever get close to shareholders. This is not some abstract metric on a spreadsheet. It is a direct hit to the company's financial flexibility and to the one thing investors value most, cold, hard cash.
Just so we're all on the same page, let's be crystal clear about what this means. Free cash flow is the lifeblood for shareholders. It's the actual cash left in the piggy bank after you've paid all the bills and invested in keeping the business running. This is the money that's used for stock buybacks and for dividends, the things that put money directly back into your pocket as an investor. So when you see FCF plummet like this, it is a massive red flag. It suggests that future shareholder returns are at risk because every spare dollar is being plowed right back into the business just to stay competitive. This is the beating heart of the bear case.
That's a powerful bear case. And that CapEx number, it's just impossible to ignore. But here's the thing. You can't judge the cost of building a skyscraper without first inspecting the foundation it's built on. If that foundation is crumbling, then all that spending is reckless, it's foolish, but if it's sitting on solid bedrock, then it's a strategic investment. So before we can decide if they're just panicking on AI spending, we have to drill down into Alphabet's foundation, the core advertising business. Is it strong, or are we starting to see some serious stress fractures?
Okay, now this is the bedrock. Take a look at the core Google search business. It brought in $63 billion, and it grew at a phenomenal 17%. Let me repeat that. The oldest, most mature part of their entire business is actually re-accelerating. All that talk you hear about competitors eating Google's lunch, this number says not so fast. Then you have YouTube ads, also growing a solid 9%, bringing in over $11 billion. Now, you'll see the subscriptions line is down a bit, but honestly, that's a much smaller piece of the puzzle. The combined advertising engine is the fortress of cash flow that funds everything else, and it's getting stronger. This is the solid ground that allows them to make those massive CapEx bets.
I'll grant you search is a fortress. I will not argue that point. But let's be honest, the foundation isn't perfect. Look closer at YouTube ads. Yes, it grew 9%, but it missed what Wall Street was expecting. Now, it's not a huge miss, but a miss is a miss. And you have to see this as a potential stress fracture. With the insane competition coming from TikTok and from Instagram Reels, is YouTube's long-held dominance starting to erode even just a little? It's a crack, and we have to ask if that crack is going to get wider over time.
Okay, we've laid out the bull case, staggering growth, a newly profitable cloud. We've laid out the bear case, terrifying spending and a potential crack in YouTube.
Now it's time to weigh the evidence. It's time to deliver the iron financial verdict. Is this company a fortress, a fragile facade, or is all of this, the good and the bad, secretly about something else entirely? An AI arms race?
So let's just recap the battle here. The bulls, they've got overwhelming top-line growth, an exploding and now very profitable cloud business, and a rock-solid search foundation. It's a powerful case. And the bears have a company that is doubling its spending, torching its free cash flow in the process, with potential weakness starting to show in one of its key growth drivers, YouTube. The risk here is palpable. So which side wins this fight?
Here is our verdict. The market is fundamentally misinterpreting that CapEx number. This is not a sign of weakness. It's not panic spending. This is the most aggressive, offensive, strategic move this company has made in a decade. Alphabet isn't bleeding cash. It is consciously and deliberately pouring a new foundation, a foundation made of custom silicon chips, of globe-spanning data centers, of pure energy infrastructure. They are front-loading the cost to build an unbreachable economic moat for the coming age of artificial intelligence. They are paying the massive price of admission to dominate the next wave of technology.
I have to concede, when you frame it that way, the whole picture changes. Look, the cost is staggering, and that short-term hit to free cash flow is painful for investors. I don't want to discount that risk at all. But viewing the spending not as a repair job on an old building, but as the construction cost for an entirely new AI-powered fortress, it makes the market's short-term panic look less like a trap and a lot more like an opportunity. They are sacrificing today's cash flow for what they believe will be a decade of total dominance. It is a bold and it's an incredibly expensive bet.
This earnings report signals the official start of a new technological arms race, and Alphabet is pushing all of its chips to the center of the table. They're betting hundreds of billions of dollars that owning the core infrastructure of AI will be the single most valuable asset on the planet. This isn't about search ads and YouTube videos anymore. They are making a bid to own the future of intelligence itself. And so the only real question this report leaves you, the investor, with is this: are you betting with them?